Hi, I'm Jimmy. In this video, we're going to look quickly at the fact that over the past few weeks, a lot of commodity prices have gone absolutely crazy. We're going to look at which types of companies could benefit from this and which ones will likely struggle. And then hopefully we can use this information to help our investment portfolios and ideally get us closer to our goal of achieving financial freedom. Okay, so let's jump right in. So the first commodity that I think is super interesting is lumber. And this is a chart of the lumber futures going back the past 5 years. And as we can see, well, prices over the past few weeks have skyrocketed, and this will affect a ton of different industries. So clearly, industries like furniture manufacturers or paper and packaging manufacturers or even home builders are going to see increased prices as raw materials skyrocket like this. Now, just recently, Warren Buffett came out and talked during the Berkshire Hathaway meeting. He came out and talked about how costs for some of the home builders that he owns a bunch of home builders, well, how costs have shot up. And clearly we can see how that's happening. Now, home builders also have the advantage of the fact that home prices are also rising right now. Are they rising this fast though? I doubt it. I'm sure in some areas they are rising this fast, but on average, they're not. In fact, this is a chart put up by the National Association of Realtors on the price of existing home sales. Sure, these are existing homes and not new homes, which is what home builders build. But either way, I think it gives us an indication of the trend of home prices. And yes, home prices are up, but they're not going up as fast as the costs are. Now, I've heard that some home builders are in fact increasing the prices for the house that they sell. So they're increasing in theory, the sale price in the hopes of offsetting some of the increase in costs. Now, depending on the type of home builder, I would think that, let's say, more expensive homes that are being built, I think that they would have a better chance of increasing the price enough to offset the increase in lumber. So I think that it's very possible that some home builders are in a decent position to do well over the next couple of years and perhaps could be a good long-term investment, depending on the position that they're in. Okay, now another commodity that affects a ton of industries is oil. And this is a chart of Brent oil going back the past 5 years. And clearly, oil prices haven't jumped as much as lumber did, but just since the start of 2021, oil prices are up 30% year to date. And off of the bottom of this chart, well, they're up almost double. Now, obviously, this is going to have a ripple effect through the entire economy. One major user of oil is plastics. It takes oil to make plastics, and plastics are used in a ton of different things. So clearly, that's going to hurt a lot of the economy. That's an increased cost. If we consider travel or airlines, either one of those, gasoline is a cost or oil is a cost. So that's going to be increased costs for those industries. Now, where home builders are able to increase their price to offset the cost of lumber, well, the airline industry struggles with that a bit more. That's a hyper-competitive industry where price matters a ton. So as oil prices go up, well, that hurts airlines. Now, yes, I recognize that airline costs, tickets for airplane tickets have clearly gone up, especially compared to last year. But still, they are going to have to keep their costs as low as possible to remain competitive. So increase oil prices like this is going to be a headwind. Now, it is possible that so many people are hyped up this year to travel because of the restrictions last year, that if more people are hyped up to travel this year, that maybe they're willing to eat the increase in costs. So it's possible that over the short term, airlines have a bit of flexibility with how they increase their prices, but it won't stay that way for long. Okay, now more broadly speaking, where higher in oil and gas prices hurt is that they have such a wide ripple effect on the entire commodity. Commuting goes up, the cost of commuting goes up, consumer goods and services often go up. So oil prices moving higher affects many industries, most of them negatively. Now, one industry that could do fairly well with rising oil prices is something like oil refiners. So oil refiners, they buy oil, so that's a cost. They then refine that oil and turn it into like gasoline or distillate fuel. Diesel is a good example of distillate fuel. Well, if gasoline prices and distillate prices are going up faster than oil prices are, well, in theory, refineries make more money. Now, we can see how that spread looks in something called the crack spread. So this is the 3-to-1 crack spread. And basically what that is we take 3 barrels of oil, and if they converted that into 2 barrels of gasoline and 1 barrel of distillate fuel, well, this is what the spread is that they make. The higher this number is, the more profit a refinery makes. And we can see that this is up as well. So it's very possible that refineries could be increasing their profits. So that might be something we consider investing in if we're interested. A lot of times these companies also pay very good dividends. So if we like dividends, this could be a good consideration. Okay, now we shift over to a more farming-based product, and that is corn. So this is a chart of corn going back the past couple of years. This is from the Chicago Board of Trade. And if we're curious, this is a price for a single contract. Each contract represents 5,000 bushels of corn. So in my mind, one thing that stands out to me is look at how stable these prices were for a while. And then a pullback happened when COVID happened. And I think this makes a lot of sense. Restaurants began to shut down, and I assume there was some drop in the demand when that happened. Hence the prices dropped. But in recent weeks, well, this price has gone crazy high as a lot of the world is coming, the demand is coming back online all at once, and there's a limited supply. Now, this is true for many of the commodities out there. If we look at the performance of some of the most popular commodities in 2021, well, we can see that nearly every one of these commodities are higher. Sure, gold is down and so is silver, but that's it. And these performance numbers are year to date, so from the start of 2021 up until the other day. Well, we saw that oil was up and gasoline is up in 2021. And by the way, that difference between gasoline and oil, that was one of the factors that contributed to the rising crack spread. So once again, a good sign that refineries could do fairly well. The costs for a lot of metals are up. Aluminum, copper, and steel rebar is up. Those are all up more than 20% year to date. Iron ore is up. So these are all higher costs for manufacturers and builders out there. So this could be a long-term problem. And that's assuming that there is enough demand for them to even get their hands on products. I've seen many companies talking about struggles to get a hold of the raw materials that they need, hence some of the reasons why prices have moved as high as they have. And if restaurants haven't struggled enough over the past years, well, we can see that a lot of agriculture commodities have moved higher as well in 2021. So in theory, what will likely happen is that these costs get pushed on to consumers. So if we were to go to a restaurant today, well, we'll likely pay higher prices for whatever the meal is because the underlying commodity, the underlying cost to the restaurant has gone up. Now, it is possible that something like corn prices, if we jump back to the corn chart real quick, it is possible that over the next month or two, corn prices drop. Maybe they drop down to here. Maybe they even drop down to here, which is more in line with the longer term history. But either way, it could take a bit of time for the demand push for the demand right now to cool off and for prices to smooth out a bit. And to my way of thinking, I think a lot of this is very logical. It's very understandable how we got in this situation when you have so many people, so many businesses coming back online at the same time. The supply is not there, the demand is huge, and fine, you get a big increase in prices. But what is a logical reaction to this is to see inflation. And clearly, there's already commodity inflation or higher commodity inflation. That's what rising prices are. And I know that there are a few ways for people to look at inflation or a few ways to define inflation. But in this case, for this video, what I'm talking about is the increase in the price of goods and services, not money supply. Since it is ultimately the increase in price in goods and services that affect us on a day-to-day basis. So if we go to a restaurant and they increase the price of our meal because their costs went on, well, that's the kind of inflation that I'm talking about. Now, Jerome Powell recently came out and said that he thought that prices would rise as the country opened back up and people started to get out there and spend again. But he went on to say that the risk of inflation, or really unwanted inflation, sticking around for any period of time was low, that there was a low risk there. And frankly, I struggle to see how, with so many commodities going up this fast in such a short period of time, well, the most logical reaction to an increase in costs for a business would be to increase assuming that they can, increase the prices to their customers. And going back to the restaurant example, if we went to a restaurant and bought corn, well, clearly the price today is going to be higher than it was a year ago. And I think that we would expect that. But let's say that the price of corn drops from the very high level that it was at, and over the next 3 months it drops, and we go out to dinner again in 3 months. It is possible, I suppose, that the restaurant dropped the price of that corn, but it's also possible they kept it right where it was at and try to make back some of the profits that they've lost over the past year. Either way, given where the stock market is currently trading today, Well, I think that if we can identify companies that are in a better position to either absorb these prices and pass them on to consumers, or companies that are a bit more defensive in nature and can perhaps profit, something like refineries, which could perhaps profit from this situation, I think it makes sense to try to pick individual companies that could do well in that situation. So in my mind, that's the way to position ourselves within our investment portfolio for the next couple of years. Now, it is possible that we go out and we find an ETF that we think could be a defensive ETF that could do well over the next few years. But a lot of that depends on our individual portfolios. Now, if you're curious about the difference between investing in stocks and ETFs, well, I actually did a video called Stocks versus ETFs. What's a better investment? So if you're curious, perhaps that's a good next video for you to watch. I got a link right here. I got a link in the description below. And thank you so much for sticking with me all the way to the end of the video. I really appreciate it. Thank you, and I'll see you in the next video.